Every day, millions of people take out loans and lose. They borrow money to buy things that lose value. They pay back twice what they borrowed. They work for decades just to clear a debt that should have made them rich. But quietly in boardrooms, in investment clubs, in private WhatsApp groups, a different game is being played. A completely different game. The wealthy don't avoid debt. They weaponize it. They use other people's money to buy assets. They let inflation eat their loan balance. And they build empires using capital that was never theirs to begin with. That last line, read it again if you need to. They build empires using money that was never theirs. That's what this document is about. The lie about debt. From the day you could understand language, you were taught one thing about debt. Debt is bad, avoid it. And we believed it. I believed it. Most of us grew up hearing, don't borrow saved money. Don't borrow, save your money. Debt will ruin you. And on the surface, that makes sense. Credit card debt at 40% interest, bad. Borrowing to buy a car that loses value the moment you drive it, questionable. Borrowing to go on holiday, painful. But here is the lie hidden inside that lesson. It doesn't distinguish between bad debt and good debt. Bad debt is borrowing money to consume. You borrow, you spend. The thing you bought loses value, and you're left paying interest on nothing. Good debt is borrowing money to produce. You borrow, you deploy, and the asset you acquired generates income or appreciates. The loan pays itself. Let me say that again because this is the foundation of everything. Bad debt, you borrow to consume. Good debt, you borrow to produce. Same action, completely different outcome. The bank understands this distinction perfectly. That's why they offer mortgages at lower rates, but credit cards at 40% and above. They want you consuming on high interest debt. They don't want you producing with cheap capital because that is what they do with your deposits. You put money in a savings account, the bank pays you, what? 7, 8% maybe on money that you've just given to them. Then they take that same money and lend it out as a mortgage, a business loan, a personal loan at 14, 18, 25%. The spread between what they pay you and what they charge others, that is their profit. Let me repeat that again. The bank pays you what? 7, 8% maybe. Then they take that same money and they lend it out as mortgage, a business loan, a personal loan at 18, 14, 25%. The spread between what they pay you and what they charge others, that is their profit. They are using your money to make money. And they've been doing it all this time. What rich people actually do? Let's get to that. Now, let's talk about what wealthy people actually do with loans, because it is not what most people think. Strategy 1, they call it the buy, borrow, die method. The buy, borrow, die method. I know how that sounds. Just stay with me. Here is how it works. You buy an appreciating asset, real estate, stocks, a business, it grows in value. Instead of selling it and paying tax on the profit, you go to a bank and borrow against it as collateral. You get cash, tax-free, because a loan is not income. You use that cash to fund your life or buy more assets. The original asset keeps appreciating, you never sell it. So they never sell it. They just keep borrowing against a growing asset. The bank gives them cash, no tax. The asset keeps going up. Hmm. And they repeat this until they die. Hence the name buy, borrow, die. You buy and borrow until you die. Yeah? You get it in layman's language. Okay. Now, you might say that that only works for billionaires, but the principle scales down. A Kenyan property investor takes a mortgage on a rental flat in Kilimani. The rent covers the mortgage installment. The property appreciates 5 years later, they refinance, pull out equity and use it as a deposit on a second property. They now own two assets. The bank funded most of it. That is the exact same strategy, just a different size. The tenant is paying the loan, the bank is financing the asset, and the investor is building net worth while sleeping. Strategy 2, OPM, other people's money. Every serious investor knows this phrase. The goal is never to use your own capital if you can avoid it. Why? Because your personal capital is finite. Leverage multiplies your reach. If you have 500,000 shillings and invest it directly, your upside is capped at 500,000. But if you use that 500,000 as a 20% deposit and take a 2 million shilling loan, you now control a 2.5 million shilling asset. If that asset appreciates 20%, you've made 500,000 on a 500,000 investment. A 100% return. Without the loan, you'd have made 100,000. That's 20%. Leverage amplified the return 5 times. Same person, same starting money, completely different results. Because one person understood how to use a loan. Let's move to inflation. And what about inflation? Inflation is quietly working for you. Strategy 3, and this one is almost poetic. When you take a fixed rate loan, you agree to pay back a specific amount. But money loses value over time due to inflation. That means the 1 million shillings you borrowed today will feel like less in 10 years because the cost of everything has risen, but your loan balance has not. Inflation is silently eating your debt. Every year you hold a fixed rate loan, that debt becomes cheaper in real terms. Inflation runs at 7% annually and your loan interest is 13%. Your real cost of borrowing is only 6%. And if your asset is appreciating at 10% annually, you are net positive even after accounting for the loan. The bank does not advertise this, but the wealthy know it. Long-term fixed rate debt in an inflationary environment is one of the best financial tools available. They don't advertise it because it benefits you, not them. If you borrowed at a fixed rate 5 years ago, that money you owe in real terms, it has shrunk. Inflation has been quietly paying part of your debt for you. Very nice. How to pick a loan you can win with. Before you borrow a single shilling, you need to understand the structure of the loan, not just the monthly payment, the full structure. First, fixed rate versus variable rate. A fixed rate stays constant. A variable rate moves with the market, sometimes down, often up, always unpredictable. For long-term borrowing, fixed rates are almost always better. You can model your cash flow. You know exactly what you are paying. Variable rates sound attractive when they start low, but financial history is full of people who took variable rate loans and watched their payments double. Lock it in if you can. Second, the loan tenure. Longer tenure means lower monthly payment, but far more total interest paid. A 1 million shilling loan at 14% over 5 years costs you roughly 1.4 million total. The same loan over 10 years cost you roughly 1.9 million. That extra 500,000 shillings, that is just interest. Money you paid for time you may not have even needed. Third, prepayment penalties. Some lenders will penalize you for paying off a loan early because early repayment cuts into their projected interest income. Before you sign anything, check this clause. You want the freedom to pay it off as fast as if you come into money. You want the freedom to pay it off fast if you come into money. Always know that. Fourth, always ask for the APR, not just the standard interest rate. The annual percent rate include all fees, processing charges, and insurance. Get the total cost in shillings from day one to the final payment. That number is the truth. That number, not the percentage they offer you in the brochure, the actual shilling leaving your account from start to finish. Now, 4 strategies that actually work. Let us get practical. 4 specific strategies you can actually use. Strategy 1, the rental property ladder. Take a mortgage or development loan to acquire a rental property. The rent covers the loan installment. The property appreciates. After a few years, refinance, pull out equity as a deposit on a second unit. Repeat. The key discipline, the rental income must cover your loan installment plus a buffer for vacancies and repairs. Never buy a property where you are topping up from salary every month. That is not an investment. That is a liability wearing a suit. I like that. A liability wearing a suit. Now, strategy 2, the business expansion loan. If you have a proven revenue model, meaning you know that for every X shillings you inject, you generate Y, a business loan is simply multiplying a formula that already works. For example, you run an online service with 200,000 shillings, you make 50,000 profit per month. You borrow 600,000, you now have 800,000 working in the business. You scale to 200,000 profit per month. Your loan repayment is 20,000 per month. Net after repayment, 180,000, almost 4 times what you made before. The critical word there is proven. Never borrow to test an idea. Test with your own money. Borrow only to scale what already works. Strategy 3, skill loans. The human capital investment. A loan to fund a skill that directly and measurably increases your income is one of the best investments available if you are precise about it. Ask yourself, what is expected income increase from this skill and in what time frame? If you borrow 150,000 to get a certification that moves your salary from 80,000 to 130,000 per month, you've added 50,000 monthly. Your payback period is 3 months. That is a spectacular return. 3 months to pay back a 150 loan from the income it generated. That's not debt. That's an investment with a serial number on it. The 6 rules. 6 rules. These are separate people who build wealth with the loans from people who build debt with the loans. Separate people who build wealth with the loans from people who build debt with the loans. Only borrow to buy what goes up or pays you back. Assets only. That is rule 1. Rule 2. The asset must service the debt. If you are topping up from salary every month, something is wrong. Rule 3. Always maintain a safety margin. Never borrow to the edge of your capacity. Leave a 20 to 30% buffer. Business hit slow months, tenants miss rent, life happens. Rule 4, understand your exit before you enter. Before signing, know exactly how you will repay and what plan B is if the primary source dries up. Rule 5, keep your consumer debt at 0. High interest personal loans, credit cards, buy now, pay later, clear these aggressively. Consumer debt cancels every strategic advantage you build. And rule 6, your credit score is a business asset. It determines what rates you qualify for. A good credit profile means you access capital cheaper than someone with a poor history. In a world where leverage is a tool, your credit score is the quality of that tool. 6 rules, not complicated. You can go back and listen to them again, but almost nobody follows all 6 at the same time, and that's the difference. Our closing remarks: the system was not designed for you to win. It was designed for capital to flow upward from borrowers to lenders, from consumers to producers, from the financially uninformed to the financially engineered. But the rules of the game are not hidden, they are just not taught. Now you know them. Use debt intentionally, borrow only to produce. Let the asset pay the loan. Let inflation work quietly in your favor. Keep your consumer debt at zero. That is how you make the bank work for you instead of you working for the bank. If this has changed how you think about money, share it to one person who needs it. Subscribe to the paper trail because there's a lot more from where this came from. And if you need to give us any suggestions on how to make this better, sponsor this episode, kindly write us an email at papertrailcapital@gmail.com. I'm your host, call me Shak Z, and this is the Paper Trail. Adios, muchachos.